I sit in Oslo, and every day the headlines in Europe are really all about the energy crisis, which has just seemed to get worse and worse and worse and worse. And at least in Norway, all the headlines are about high power prices, and I think you'd see the same thing across European media. So politicians are responding to this, and here you see it on the graph. Offshore wind is a source of domestic energy, does not rely on imports like gas, coal, oil, etc. Wind turbines are produced in Europe, unlike solar panels where 80–90% of them come from China. So it is the most, let's say, energy independent source of power that Europe is producing. And therefore, politicians are very happy to get behind it, and you see that in the targets. So this year has just been an acceleration of the targets that we've seen from these countries. And I mean, politicians' targets are not something that you necessarily place a lot of weight on as a financial person or as an economist, but actually, if you look at the history of these targets, they've typically been exceeded. So I think that there's a lot of credibility. So we see UK today has 12 gigawatts, going to 50 by the end of the decade. Germany has 7, going to 30. You look at the Netherlands, has mid-single digits, going to 20 by the end of the decade. I mean, the growth is exponential. And as a result of that, what you see is that the number of turbines that are going in the water, these are our estimates here on the right-hand side in the red, is expected to rapidly increase in the next coming years. So this is, largely, a lot of it's Europe, but also North America. I mean, we're going from, what do we have, 8 turbines in the water in the United States? We'll have several thousand by the end of the decade, and it's starting right here. So next year in Massachusetts, we'll see the first big project go offshore. So I think one other thing before I move on that just on the macro level is offshore wind is not expensive. It's cheap. So if you look in the most recent auctions, developers bid in to provide power, typically against long-term offtake contracts from governments. In the latest round in the UK, the bids were around £40 per megawatt hour. I just looked at the futures market in the UK. For next year, the power price is 473. So power prices are more than 10 times next year 12 times actually, what the break-even costs are, including equity returns. So, you could say, okay, gas prices are high, those prices will come down over time, fine, but this is some of the cheapest power in the grid, and it's also some of the most reliable. So it's 50–60% capacity utilization versus solar is like 20, right? So offshore wind is cheap. Politicians love it. It doesn't have permitting problems in the same way that, say, onshore wind does. So this is something that politicians like. The economics make sense. It's great, yeah? The biggest challenge when it comes to offshore wind is not economics in the sense of costs of the electricity versus what they can sell it for. It's really supply chain, right? It's responding to this extraordinary situation and extraordinary expectations for growth through the end of the decade and trying to design a supply chain that works for it. And that's true for vessels, which we'll focus on today, but it's also true for every single other part of the value chain in offshore wind. It's true for turbines, it's true for foundations, it's true for every component that goes into an offshore wind farm. And I think that many of you have probably seen headlines and lots of press releases about new orders, and I think you get the question from time to time, is this going to be like deep water drilling rigs back in 2012, 2013, and this is going to come crashing down? Well, there's a lot of differences. I mean, I think one is that you have to remember that the turbines that we're installing now or in the years to come are just a completely different scale than what we've been putting in the water. The turbines are now the size of the Chrysler building, and you're going to put 100, 150 of them in the water. You need big boats to be able to do this. So you look at the existing fleet of turbine installation vessels, it's about 15. And you have a big order book, right? I mean, I think that it jumps out. It's 13 new builds that we consider credible. So you get to, a pretty big fleet growth number. But the reality is that when you start adjusting for the size of the crane, you have to have a big crane to lift something the size of the Chrysler building. We start adjusting for how tall that turbine is, right? Actually, you're not seeing nearly as much growth. It's still significant compared to the existing fleet, but then you start looking at efficiency, right? Because these are transport vessels, they're not only installation vessels. So you actually have to put the turbine on the vessel, bring it out to the offshore wind site. And if you can't carry many turbines, well, then it's going to go really slow. So we've adjusted for some efficiency there as well. And so by the time that you make all those adjustments, as far as we see it, the fleet isn't actually growing at all, despite that rapid growth in turbines that's expected in the years ahead. So you can also look at it another way, right? I mean, you can look at that order book and you can get a little scared, but I think you also have to understand like the way this business works. So the way that what the vessels actually do. So they install turbines, but they also install foundations. So every turbine needs a foundation to sit on. If you look at the turbine fleet, it looks like it's growing a lot, yeah, because that's where a lot of the orders are going. When you look at the foundation vessels, it's barely growing, and actually you dig into that fleet and 2/3 of the foundation vessels are from oil and gas. And given where oil and gas prices are, and given the fact that these vessels are designed for that market and can get paid better in that market, we think a lot of those will migrate back. So I think, in its totality, it really doesn't look like there's that much fleet growth, even if you don't start adjusting for turbine sizes, et cetera. So here, we do a quick exercise, including the foundation vessels, because I'm sure Erik can confirm a lot of the vessels a lot of the assets they're putting in the water are actually foundations. So you get a total fleet, including both vessels, vessel classes. Think about this like VLCCs and Suezmaxes, right? You can't really just look at VLCCs. You have to look at the larger tanker fleet. You throw in order books, yeah, then you get that growth. It's less than the near doubling than what you would think from just the WTIVs. But then, you can adjust for oil and gas, and even not adjusting for any efficiency, any upgrades, anything like that, the growth that we see is nothing compared to the turbine installations, right? We're looking at 2.5x over the next 4 years in terms of turbine installations. So I think I'll round off my comments with that, which is that offshore wind is cheap, it's popular, governments are willing to provide the offtake. You're not selling oil into a spot market, you're selling power on a 15-year contract with a AAA sovereign. And the financing is there. It's really about these guys here. It's about the supply chain. There's not enough, and I think that means set up to make some money.
Do I use it?
Yeah, you just tell me to put it on the Weber.
Okay. Can you put on the Weber research presentation, please? Oh, there it is. All right. Thanks, Turner. I want to start by thanking Nicholas and the Capital Link team for having me up here. I remember my first few days in the industry. This was my first conference, and sitting out there frantically scribbling down every word that everyone at the podium said, thinking that every word was incredibly important. And now I'm the one at the podium, and I can tell you that that's absolutely not true. So seriously, thank you to the Capital Link team for having me up here. It's great. So there we go. My name is Greg Wazakowski, Senior Analyst and Head of Research at Weber Research and Advisory. We're an independent sell-side equity research and advisory firm. We do traditional equity and industry research. It's pretty familiar to the sell-side world. We also do energy engineering and technical consulting that I can assure you looks nothing like the traditional sell-side work, but in a good way. We also do a lot of interesting stuff on the advisory and consulting side of the business, which is actually where Mike Weber, for those of you who know him, now spends the majority of his time. We cover about 20 companies in the traditional sense of the word. We follow a couple hundred more across energy, really focusing on renewable energy, clean tech, LNG, and shipping. I spend the majority of my time on the left side of the screen there. I like to say that we really go where our clients lead us. In the past few years, that's really been into renewables, clean tech as a whole, specifically into hydrogen and other alternative fuels, as well as EVs and EV charging. We do cover TPI Composites, ticker TPIC, which is a wind blade manufacturer with plans to move into the offshore space, which has prompted our attention as well as our clients' attention into offshore wind development. So I thought I would quickly cover a few of our key takeaways on offshore wind through that process, as well as some of our key points and takeaways about renewable energy space as a whole, kind of making that transition. First, these charts, and the charts I'm sure you'll see in Eneti's presentation, as well as pretty much any metric that you look up, it's pretty clear that the demand for low carbon and low cost energy is driving offshore wind. What might not be as clear is the lumpiness associated with that growth. So you see in the bottom right-hand forecast, the two pretty well-known forecasts, and what you can notice is not only are they very different, but they don't have that upward slope that you might expect to see with a high-growth industry. That for me, that gets exacerbated by the high capital-intensive nature of this business. When you combine those two aspects, you likely get an industry that's led by giants with a wealth of experience and deep pockets. It's not something that we necessarily see through the rest of our renewables coverage, but can certainly see it here. And lastly, combining all those factors, what you get is the number of pure plays are limited. Finding an investable name on a U.S. exchange with enough daily trading volume can definitely be challenging. Which tends to introduce a degree of scarcity value for the names that fit that criteria or tend to come close. That's something that we tend to see in our other renewables verticals as well. It kind of brings me into the key points on really transitioning from cutting my teeth in shipping and moving over to the renewables world. The space moves incredibly quickly. It's not just the companies themselves, but their stock prices as well. Many of you might be familiar with Plug Power. It's a company that we cover. When we started covering them, they were a couple billion in cap with just a lot of ambitious growth plans. Within 12 months, they exited the year at $35 billion in cap and enough balance sheet to cover all of those ambitious growth plans and more. So it just, the space as a whole really tends to move quickly. Two, valuation is a concept. And what I mean by that is, you can basically throw your NAVs out the window and, think of it as in a different sense. A lot of companies we cover trade off of FY4 sales multiples. You heard that right, FY4 sales multiples. For example, if we attributed the same multiple to Frontline that Ballard Power regularly gets, Frontline would be trading somewhere between $65 and $130 a share. So the valuation multiples are pretty crazy in the renewables land. With that rapid growth, it can kind of be ironic with the companies. What I mean by that is, many companies in our coverage actually de-emphasize or straight up ignore margin in order to further boost revenues and market share gains. And it's basically a land grab and worrying about margin at a later point, which is interesting. And that tends to come to frustration to investors. So, a word of advice that we typically have to our investors is patience is key. These companies, some of them trade off of FI4 multiples for a reason, and they're not expected to hit their stride until 2025 or 2026. They're very open about it, but they still have to answer to all these quarterly earnings calls, and it can get frustrating to have that relative disappointment every quarterly earnings call waiting for 2025 and 2026 to come about. With that being said, one of the most effective strategies that we've noticed from our clients is to basically look past the rising tide. So it's the phrase that the rising tide lifts all boats. But really what I found people to be successful in the space is kind of looking past that tide, looking at what business models and what companies are really set up to succeed in the late 2020s into the 2030s when some of the government support and tax credits maybe start to dwindle away. Who's set up for success in that sense. That's something that we've thought to be a particularly thoughtful approach. So that's it for me. I'll end it there, and happy to connect about it or any or all of it after the panel. But I think I'll turn it over to James.
We'll go to the Eneti presentation now. Great job, Greg and Turner. I'm James Doyle. I'm the head of corporate development and IR at Eneti. With me is Erik, a managing director at Eneti, who works on our projects, operations, and technical. So you guys did a great job highlighting why we were investing in offshore wind to begin with, especially as a company that's more focused on maritime. This is a little bit more maritime plus engineering. But when we looked at offshore wind, we saw a tremendous build out that Turner highlighted and a relatively short supply despite additional new building orders coming out. I'm not going to re-hit the market slides that these guys covered, but I'm just going to talk about what we've done at Eneti for a few minutes before I pass to Erik. And we've added a fair bit of contractual backlog, so about $180 million since the start of the year. And when we looked at offshore wind, we decided to first order our own vessel, given the supply-demand outlook that would deliver in 2024. And then we had to figure out how we were going to operate this vessel in what is a small market that needs basically a significant track record, as Turner mentioned, with these large infrastructure projects. And the developers don't want to take risk. So we spent a great deal of time acquiring Seajacks, which owned 5 vessels, had a great track record, one of the most advanced WTIVs on the water, and we did that last summer. And since then, we've been in the process of improving the quality of our investment, especially to the public, but also internally trying to get the best operating results, most transparency we can in an industry that's relatively opaque and has a lot of private players. And then we got a new loan facility, a $175 million green loan facility with the revolver component and multinational kind of currency capabilities. We increased the contractual backlog. We ordered our second new building, which we had an option for $323 million. And then we've spent the next several months really working on contracting our new building assets, which Erik will speak to a little bit. We've divested from our investment in Scorpio Tankers, and we've just declared our 3 smallest assets as non-core for a potential sale, as while they work in offshore wind, they also work in oil and gas. So we've done quite a bit over the last 12 months. We've made a lot of progress, and with that, we'll pass to Erik, and he can walk you through how we're thinking about offshore wind.
Thank you, James. Good morning, all. My name is Erik Gurrik. I'm a managing director in Eneti. I'm Norwegian. Nobody's perfect, right? So I actually started in this space 11 years ago, in 2011. I've seen turbines grow from 3 megawatt sizes to 7 megawatt sizes during 5 years. And now we see the sizes even doubling within the next 5 years. We've taken delivery of a couple of new buildings that are currently on the water that has their crane upgraded. And when we took delivery of those vessels, we upgraded the legs and the cranes just 3 years after delivery, because the size of the turbines were so large, so they couldn't handle the sizes anymore. I actually been a part of installing the first turbines in the US in Block Island, consisting of five GE turbines back in 2016. And when I started in this space in 2011, there was an extremely tight market. There were so many, an extremely tight market. But I have actually never ever seen a larger imbalance between supply and demand that we are seeing ahead of us now. I think what I would like for you to take away from today is there is this big bottleneck, as Turner alluded to, in the supply chain, but we see it obviously on this vessel supply side. And the other thing is that Eneti, as a company with fleet on the waters and new buildings coming into the space, we are well positioned to enable and take care of that bottleneck, and well positioned for looking further ahead throughout this decade and even further with the existing vessels and also the vessels that are coming online. So, I mean, these vessels, they are not basically a major part of the total construction cost. 2% of the installation, 2% of the construction cost in an offshore wind farm is related to wind turbine installation vessels. So, and these vessels are getting larger, and the cranes are, and the existing fleet are not capable of lifting these turbines high enough and with heavy components as we see coming into the market in 2023 and 2024. Secondly, as Turner says, for every turbine that goes into the water, there needs to be a foundation standing there. You need to build the turbine onto a foundation. So with the new buildings that we have, with the cranes and the crane sizes that we have chosen, we would be capable of both handling the foundation installation market and the wind turbine installation market. And the fourth point I would like to mention is, in fact, the barrier to entry. Everybody, in shipping, you could say, well, we could just build more vessels. And we tried that. As James said, we placed our first new building order in May last year. But we were really hammering on customers' doors, and they said, well, do you have the experience? Yeah, we have experience. We have product tankers. We have 180 product tankers. We have 55 bulk carriers, so we have maritime experience. And they said, well, that's not enough, because you need references, you need experience in this space, and that's why we acquired Seajacks. And that's why we think that we are extremely well positioned with existing fleet and the new builds. Yeah, and last but not least, when I started in this space, it was all Europe, right? It was Germany, it was Denmark, and the UK. And Seajacks, which was one of my main competitors back then, were taking a lot of orders. But now the market is turning three-dimensional in a way. You have a big demand in Europe, you have an increasingly demand in the APAC region, and you also see the 30 by 30 vision here in the US with offshore wind really is coming into play for the next decade. So we are positioned in all those markets. We have been operating this vessel since 2009 and installed more than almost 600 turbines, accumulated 2.5 gigawatt installed capacity. We have installed almost 500 foundations in the water today, and we are becoming a global leader in a way. So we are having our current vessels, two biggest vessels in Asia at the time, and the Zaratan is working in Japan, and the Skylla is working in Taiwan, and now we are taking at least the biggest one out of Taiwan and going back to Europe, and that's like a 70 days journey and probably a $20 million of accumulated cost in transit and day rate equivalent. So it's a lot of money to mobilize one vessel to one part of the world to another. And the developers that are developing these projects, they want to see which vessels are where. And as Turner and some else have said, it's a very transparent market. It's very few vessels. You can actually watch them and see where they are at some point in time, and you can see by announcement where they are and when they are committed and when they are not committed. So I think for us, you could say, well, why, and you probably could see that Eneti, we haven't committed our new buildings yet. And why is that? Well, that is because we believe that the market is going up because there is a huge bottleneck. So we want to wait and see until we have the right pipeline and the right utilization for these vessels, wherever it may be. So we have this wonderful partnership with Dominion Energy in the US. We are a consultant to Dominion Energy, where we are actually together with Dominion, responsible for constructing the first jack-up or wind turbine installation vessels down at Keppel Amfels in Brownsville. So we have the new building supervision team down there. We are setting up the operations for Dominion for this vessel going to be delivered in 2023. Asia we have talked about, and Europe is obviously with the Baltics now coming online, UK, Denmark, Germany, France, and everyone. So this is a really promising market, and we believe that we are leading in all those markets based upon our experience and based upon the presence in all of these global markets. Yeah, the track record speaks for itself. Company has been around since 2009 with 5 vessels on water. And you might think, well, the turbines are getting bigger, but so these vessels need to be upgraded. Yeah, that's correct. 2 of these vessels, the largest one, they at a certain point in time need to be upgraded. But in this market, they don't, because there are constantly requirements for different types of work in the offshore wind space. We can upgrade both of the largest vessels. We can actually put on the largest crane that we have on the new buildings on the largest vessels currently on water. So these vessels are capable of being in the market for several years to come. So we have 400 employees, 300 excellent seafarers, and 100 people in the office worldwide. And we have overseen construction of our 5 vessels on water, and with the Scorpio history, we have taken 180 new buildings out of Korea. So when we as a company decided to enter into this space, we wanted to lower the risk. So what did we do? Well, we choose the best and most capable designer of these vessels, Gusto. We choose the best and capable crane manufacturer in Huisman. And obviously, with our experience, we more or less the first day said, well, we want to build in Korea because that's where we know our stuff, and we rely on them. And we're working for all these major developers, and these are some of the references that we have now, and we're working on towards 2023. And as you saw from the charts earlier, we thought with our new buildings coming into the water in 2024 and 2025 that we would hit the target straight away. But we see that this increasing demand even further than that. So we actually committed our vessels in 2023, 1.5 years ahead of that calendar year. So we're basically fully booked during during 2023. So the new buildings, yeah, they are vessels. They have a large crane, 2,600 ton, a very large deck space to carry components, both turbines and foundations, as I said. They have kind of peculiar vessels in a way. They have long legs. We jack the legs down into the soil, and then we jack the vessel out of the water, so we have fixed ground to stand on while we are building these turbines as we speak. And when we're finished, we jack down, move to the next location, and do the same cycle. So it's about carrying capacity, and it's about, as Turner said, it's about lifting capacity, having lifting a nacelle 225 meters above water at the weight of 1,000 ton. That's precision work, right? So you need to have capable vessel, and you need to have vessels that has a reserve, so they are able to, when the new turbines are coming into play in 2030, and we believe that they will, because we don't see that this will stop, at least not yet. We are built in reserve in these vessels. We are capable of taking the next platform of wind turbines coming into the space. Obviously, environment is extremely important to us. We are running on marine gas oil, but we are also ready to burn ammonia or LNG if the market wants us to. We have a battery capacity on these vessels where the vessels are capable of operating on electricity while at port, and also capable of running on batteries during operations out in the field. And all of this will basically reduce the CO2 emissions from 31% down to 80% reduction. So there are a lot of technology innovations in the market today, and that will also increase going forward. So that is the story that we wanted to tell you. So bottleneck, yes, definitely. We see a very big bottleneck both in the foundation installation market and the turbine installation market. And obviously our positioning in that market with the capable vessels we have on water today and the new buildings that are coming into the space in a couple of years' time. So with that, yeah, I think we'll
Q&A.
open up for Q&As. Thank you.
Could you comment on your strategy for the U.S. market? This is for Eneti.
For NETI. So we paused our progress with the U.S. market. We needed three things: a shipbuilding contract, which we were going to do at Brownsville in Texas, the same as Dominion, a U.S. partner to have the majority ownership to comply with the Jones Act, and we needed customer contracts. Erik made a great deal of progress on the contractual side of the business. Typically in this segment, you see kind of 8 to 12-month contracts, and then the vessel goes on another contract, sometimes with a different developer, sometimes with the same one, but not a multi-year charter. And we made some progress in getting that. We worked with different potential investors for the financing and partnership. What ultimately happened is we ran out of time. And given the significant cost of a WTIV in the US, around potentially over $500 million, and missing or not being able to meet our first contract, we ran out of time. And so now you basically have to look at the feeder barge solution and an international WTIV to meet those projects that do have a 2025 or 2026 start date.
Can I just make a comment? One thing that you guys didn't mention, but I think that the audience would be interested to know, is that the stock's trading at half a NAV. Yeah, I mean, so we have a $16.80 NAV. It's below 17 bucks. The stock's at $8. And I think that, okay, you know, we've seen shipping stocks that trade below NAV before, but that's typically in markets where the rates are depressed. The rates are crazy. I mean, I was listening to the container panel earlier, like, you know, they're saying they're trading below NAV. I guess that's a consensus in many cases, but that market is, you know, the spot rates are collapsing, right? Here it's the opposite, right? The spot rates are going up. And as Erik pointed out, I mean, you have some of the few available vessels for these projects that are coming up in 24 and 25. You don't have any balance sheet issues. Balance sheets fully financed, been buying back shares at half of NAV. You bought back about 6% of the cap recently, and then just did an authorization for another 15% of the cap. Market's good, balance sheet's good, trading at half NAV, buying back shares. I mean, I frankly, I think it's, I used in one of my research notes a word that I've never used before in a research note. I think it's absurd. And I think that it's just a function of that. You know, company's been under transformation. It was a ship owning business, right? It was in dry bulk. And I think it just takes people a while to figure it out. But I just think it's one of those opportunities that doesn't come along very often. And that people should take notice.
I have a question back here. Turner, based on your presentation, the number of turbines, large turbines, that are going to be installed on an annual basis is going to quadruple over the next several years, right?
Something like that, yeah.
Right, and the effective capacity to install these things isn't going to change much. So unless utilization of Erik and other people's fleet is capable of keeping pace with that growth, then the installations can't happen, can they? So what do I mean? It's either a fantastic scenario in which installations will be pushed out for a number of years and developers may be unhappy or they may be happy because they get to rebid, because I'm sure they have a tremendous amount of remorse now, given competitive costs of electrical generation and the supply chain costs. Or Carl Eric's going to find a way to utilize his vessels, and his compatriots are going to do the same. So what is it? Because there seems to be either a great
you hit the nail on the
or
head.
something that's going to correct itself.
That's it, right? I mean, that number is based on projects that we look at. We build it up. It's like developers, Ørsted, big utility companies, Equinor, BP, Total, the big oil companies as well, who are throwing money at this business, by the way, from their record cash flows. That's what they want to do, right? So we kind of build that up. We look at the projects that they have, all right, what they're saying. They want to build this offshore wind farm in Germany or the US or the UK or what have you. And then we kind of build up the demand that way. But like you said, it's a bottleneck. I mean, I go to a lot of these offshore wind conferences. I know a lot of people in the industry. I cover a lot of stocks in the space, and everybody says the same thing, right? It's the same thing. It's the supply chain is just not scaled up to be able to deliver that, right? So if it doesn't happen, it's because the supply chain is running at full speed. But if you're an investor, right, like Carl said, it's 2% of the capex, right? Like it's like you pay up to get that vessel. You pay up to get it down, to get it done, right? And if you're a developer and you're building an offshore wind farm, right, that's going to deliver power, and you have to deliver it by a certain date to get that offtake with the government, right? Like you have to deliver it. You go get the vessel. You pay what you need to do. So, if those estimates overshoot, right? Like if it ends up lower than that, it's because the supply chain wasn't able to keep up. And if the supply chain isn't able to keep up, then these guys are sitting in the catbird seat, as we say in Tennessee, where I'm from. But you're in a very pretty position.
We see then more and more that developers having the bargaining power for many years until they also see what is happening in the market. And we see that they are contracting further and further ahead. They want to secure their capacity. I mean, guys like Equinor or Ørsted, they are all around in the world. They are in the Baltics, they are in the UK, they are in the US, they are in Asia. And they want to commit the vessel as soon as possible because they feel that is one of the most critical factors. They have signed the TSA or the turbine supplier agreement with GE, Vestas, or Siemens, but they need somebody to put that up, and they are knocking on our door basically to ask if we have that vessel available and the market terms for that vessel.
If I could add as well, I mean, it's a very important topic, right? So 2030 is still a ways away now. You could get delivery of a vessel probably first half of 2026 at this point, right? So there's still opportunities for it. And so what we do see as well is that the big developers are awarding basically contracts for new builds, right? So like Cadler, which is one of the other pure plays in the space, they've done that, right? The Ørsted basically signed them up and new build against a contract. That's historically not been the case because these vessels are they're for construction projects, right? So like unless you have a huge sort of portfolio of construction projects, and each construction project is happening in a different place on the seafloor, in a different country, at a different time. Like it's sort of hard to build out long-term contracts for WTIVs because the specs have to be designed for a specific place, seabed conditions, a specific turbine model that you're putting in, right? So it's not fungible in the sense of tankers or bulkers or even containers. And so we don't see a lot of long-term contracts, usually a year or 2 or 3. But now I think that the portfolios are getting bigger for the big developers. They see the challenge that's coming, and we speak to these guys. They're aware that like this is going to be a problem at some point, and we're seeing some action in terms of awarding contracts for new builds. So I think it's arising in terms of people's consciousness, but it's still a couple of years away. Right, so it's kind of like, we'll cross that bridge when they get there. But that's the attitude.
But the developers are also extremely project by project thinking, because in every wind farm they always bring along a partner. So contracting or making available a pipeline throughout, let's say 3, 4, 5 years of installation pipeline on 4 or 5 projects with different partner in each project. That's what the developers claim is extremely difficult, and that's why. And they have these are more often state-owned or partly state-owned companies, so they have their tendering process, they have this rigid procurement process. So sometimes they have a very hard thinking differently about things than you and me.
Are there any, I guess, shortages that you're contemplating in terms of the U.S., the first few projects to come online, and kind of bigger picture, anything that you kind of see, given the considerations of the Jones Act and how that market develops here over the next few years?
I think there are, in terms of Jones Act, I really think that or see that is strengthening. I mean, the last this administration has done is basically to say that every international vessel coming into U.S. continental shelf either should have a crew by the flag state or U.S. crew. So with that in mind, we have vessels, our vessels flying Marshall Island flag. I worked in a company which had Maltese flag, and I can tell you neither Malta or Marshall Island have these kind of crew members. And then you have the installation technicians. They are on board these vessels working. So if the installation technicians also need to be U.S. flagged or U.S. citizens or flag state citizens, then that will also be a huge bottleneck. But creating this pipeline, as James alluded to, and it's extremely difficult because the procurement process, the permitting process, and it's not just here in the US, but it's all over. So normally the developers would like to enter in what they would call a preferred supplier agreement. They nominate a supplier of a wind turbine installation vessel, but it's only 1 year after that then they make a formal FID. So and that time from them making an FID until that vessel is going to be constructed versus the time it actually takes to construct that vessel, that's not aligned. So we would never ever build a vessel at $550 million based upon a preferred supplier agreement, because that's not bankable. So, but the Jones Act is here to stay, and I think that's how we need to look upon it. But then again, for us, I mean, we see the US as a very prosperous market. But again, the irony of it is that the more international vessels that are going into the US, the tighter the market will be, right? So we actually don't need to do anything in terms of the tightness, but we do see US as an extremely important and exciting market to be in. So we want to try to achieve that.
I could add one more thing to that. It's just that I think the concept of a new Jones Act WTIV is dead. So we have one that these guys are working with and supervising, but I think it's also the process that they went through shows how painful it is to try to get that done, and it's just so expensive compared to what an international vessel is. But now we see players like Maersk, for example, has gotten, 4 years of contract backlog. In the US market, you're applying different techniques where instead of the vessel just being being both a transport and an installation vessel, it basically just becomes an installation vessel. It has a sort of deck that sinks, a barge comes in, it brings it up to the top, and then you move the turbine onto the vessel. So we're seeing some new technical solutions, but I would say, looking at all the markets around the world, the US has the biggest challenges with supply chain, largely due to the Jones Act, but that's not the only one. It's just, we're trying to go 30 gigawatts and from nothing today, 6, 7, 8 turbines, and you just don't have a supply chain here. But it'll figure it out. US is obviously put your minds to it, get it done. And there's 120 million people on the East Coast. It's a massive market. There's no room for massive onshore wind farms and solar farms. But what do we have? We've got a lot of shallow waters. We've got a lot of wind. And so offshore wind is going to be the thing that makes sense, but it's going to be some trouble with the supply chain in the first few years, but we'll figure it out and get it done.
Hi, there have been some high-profile losses associated with some of the installations, either with the cables or I believe in Taiwan, where the contractor was on the hook. Wasikowski came out recently publicly and said that the risk profile was disproportionate for the contractors as opposed to the very large developers sponsoring these projects. Can you comment a bit on what your risk profile is when you sign up to install 100 turbines, for example?
Yeah, I can comment on that. I would say that there are things we do and there are things we don't do. So we have an extremely low risk profile. If you look at our customer base, all of the so-called EPCI contractors, they are on our customer list. We work for the EPCI contractors, so we know we never ever take weather risk. We don't take upon full contract or TNI or EPCI contracts. So as you say, the developers are trying to push down their risk into downwards in the supply chain, but we are not doing that. We are chartering out our vessels on a time charter basis, and that's it. With some engineering services, and because there are a lot of technical stuff that needs to go with this vessel in terms of soil. We have a project now in Taiwan where we're penetrating 40 meters down in the seabed. There are liquefaction risks, there are earthquake risks, so we need to do those installations in certain modes. So then there goes along a lot of engineering with it, but that's not our responsibility. You know.
Thank you very much.
Thanks, Kevin.